we were in negotiations.
Investing in real estate, they're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you could build on. I am your host, Kevin Amolsch. This podcast is so much fun, and unlike many that I've seen, in that we help real estate investors and real estate educators. So if you're an investor or if you're providing content to investors, this is the podcast for you. We have a special quarterly market pulse update coming at you today with our good friend and co-host, Mr. Justin Cooper. What's up, Justin?
How are you?
I'm doing good, man. Why are you laughing at me?
I'm laughing with you, Kevin.
Yeah, thank you. And our very special guest and good friend and local, Denver expert, Mr. Joseph Massey. How's it going, man?
Nice to see you guys. Always appreciate you guys inviting me to join the podcast. As you guys know, I love talking about this stuff. I dream about like graphs and charts and mortgages. So I'm just always grateful when you guys bring me on here to talk about fun stuff like statistics. So thanks so much for having me, guys.
I think this market pulse quarterly thing that we're doing here is building some traction, man. I think people are really liking it because it's keeping people current on what's going on in their own backyard. So if you're in Colorado, specifically in the Denver area, that's kind of what we're focusing on here. I think this is a great podcast to stay current and help protect your investments. So what do you think, Cooper? Should we start more of a macro level, or what should we be talking about today?
Yeah, I think we should start high level, and then we can start bringing it down more local into what's going on here in Colorado and maybe even Denver.
Okay, great. So, Joe, what the hell's going on with interest rates, man?
Oh, dude, they're going to be at 18%.
Hits you right out the...
No, I'm just kidding. Interest rates are interesting, to borrow a phrase from our good friend Matt Pillmore.
Yeah.
What we've seen about 45 days ago, we saw interest rates go back from the high sixes to up over 7%. That created a little bit of anemia in the market where everybody said, oh, let's put the brakes on. Let's see what happens. Interest rates got up to 7.3, almost 7.4% as of about 45 days ago, but have started trickling back down. We're now right around 7% as of the day that we're recording this, depending on when you're listening to it, maybe a little lower, maybe a little higher. But what I'll tell you that's really hurting buyers, I think, is the volatility. When interest rates are at 6.9% and below, but then they cross up over 7%, there's a lag, right? From when somebody gets pre-approved and we talk about terms of the loan, and we say, hey, your rate's going to be about 6.9%, but it's not locked in until you get under contract. And they get under contract 30 days later, and we sit down with them and we say, hey, rates are 7.3, and it's always the same conversation. But Joe, I thought rates were 6.9. Well, that statement is correct. They were 6.9. Now they're 7.3. And that creates a little bit of fallout that people say, well, I don't like that. I'm going to cancel this contract. I'm going to wait and see if things improve. And so when rates swing from lower to higher across an emotional threshold like 7%, that creates a little bit of uncertainty and people will put things on hold and wait. So I think if rates are above 7%, that's okay. I think if rates are below 7%, that's okay. It's when the volatility crosses between the two, it creates a lot of uncertainty and a lot of people just say, maybe I should put the brakes on and just wait for the time being.
Yeah. Well, I haven't thought of it like this, Joe, but what you're saying is like that 7% is almost like a benchmark. And because really rates are not that volatile. It really has been floating around 7 for an extended period of time at this point.
Yeah, almost 6 months.
Yeah. So it's not like it was a year ago where it's just like, we don't know what the heck is going on, right? So I think that stability brings confidence. But what you're saying is that could be true and maybe not because of that, that benchmark.
Yeah. The difference between 6.99 and 7.01 is not a very big difference in your actual monthly payment, but it's a very big psychological difference.
That's crazy.
And so while we're trading in about a half-point band, that swing from one side of 7 to the other does create uncertainty and cause some folks to say, hey, I'm going to wait another year. I'm going to wait and re-sign a lease for another 18 months or whatever it might be, which leads to that we're going to touch on some increasing inventory, because when rates go above a certain level, you see that demand goes down a little bit. When there's less demand, properties sit a little bit longer and you see more inventory, which is a stat that I know we're going to look at here in a few moments.
Yeah, and I want to talk about higher for longer for just a second. So we know it's an election year, and you don't usually see a lot of big moves. So you wouldn't expect the 10-year, which is how they price mortgages. You wouldn't see that. I wouldn't think fluctuate too much. And then the federal funds, the overnight rate that banks borrow from each other, basically, has been steady as well. And
Mhm.
now they're indicating maybe no cuts this year. What are you hearing?
Yeah. So at the beginning of the year, everybody was speculating there would be 6 cuts to the federal funds rate, the overnight funds rate. And so far, we've seen zero. We're here into the middle of May. And right now, the predictions are, well, maybe 2 cuts. In my experience, when you get to about September in a presidential election year, nobody's making any big changes. Nobody that has a high powered position like the Federal Reserve is going to make any big changes because it's going to look too political. It's going to appear that they're influencing one thing or another for one side or another. So by the time we get to late August or September, everything in my mind is probably going to be pretty status quo for about 90 days. And then here's an interesting stat. After the presidential election, do you know what will happen with interest rates, regardless of who wins? Do you guys know?
I have a guess, but I want to hear what you think.
Rates will go up.
Yeah,
Rates will go up
that's
from a
what I would have
quarter
thought.
to
Yeah.
3/8% within 15 to 30 days after the election, regardless of who wins. So a lot of times people, once we hit that August, September timeframe, you hear a lot of people say, well, I'm going to wait and see what happens with the election. Well, that's an easy answer. Rates are going to go up after the election. It happens 100% of the time after
That's
presidential
amazing.
elections.
And so the rates you're talking about going up, you're talking about the 10-year.
I'm talking, yeah, 30-year fixed rate mortgages based on the 10-year treasury.
Yeah. Because we don't I have heard some rumblings that the Fed may increase that federal funds rate, which will absolutely destroy the stock market, by the way, in my opinion.
Hmm. Hmm.
Um, so Coop, what are you thinking? Or what are you seeing?
I've been hearing the same type of thing. I've been hearing that we probably will not be seeing any rate cuts this year, potentially not for a couple years. I think we need to start bracing ourselves, or maybe not bracing ourselves, but embracing
Embrace it.
these interest rates, right? Because I don't think they're going to change. We're all crossing our fingers and hoping so, right? But the things I've been hearing and the people I've been following, way smarter than me, say interest rates will probably stay the same for quite a while, not just through the election, but potentially for a couple more years. Um, so I think that's something that we all need to get more comfortable with. And I think it goes back to the theme I think that we've had for a couple of these episodes, which is buy now. There's no reason to wait, right? We're not going to wait for a crash. We're not going to wait for interest rates to drop tremendously. So if you find a good deal, then you should be buying now.
Yeah, I completely
So
agree.
I heard Barbara Cochran saying, I think most of us know who that is, prolific real estate investor. So I heard her say she believes if there's a mortgage rate decrease of about a 0.5%, she would expect to see a double-digit appreciation in housing in a quarter. What do you think about that?
I think that is probably A, true, B, not super likely to happen because I don't see any economic driver that's going to decrease interest rates by 0.5%. But if interest rates were to go down by 0.5%, remember that psychological threshold we were talking about? All of a sudden, you go below 6.5. Now you can get 6.25, 6.0. That's going to get a lot of people off the fence. That's going to drive a lot of demand. What does demand do? Pushes up prices, particularly when we have very short supply and very low inventory. So I think that analysis, I had not heard that, but thinking through it, it's probably correct. I don't know that it'll happen this year,
Yeah.
but I think she's spot on with what that would do if that were to happen.
Yeah, that feels a little aggressive to me, and
Yeah.
obviously we don't know, but she definitely thinks home values are extremely sensitive to rates right now. That's what she's saying basically.
Hmm.
And all if we see a double digit appreciation on real estate is a big chunk of the CPI and
Hmm.
PCE.
Yep.
So we will see an increase in inflation, and the government cannot afford that. You guys, they can't afford to have that, and they're already pumping money in, and we could talk more about that, but they are spending again.
Yep.
So that's going to apply some pressure to inflation. So, yeah, I think the theme here is, like Coop said, let's embrace it. It's here, guys.
Yeah, I think you're exactly right. We're not going to go back to 2%. We're not going back to 3%, 4%. We're going to have higher interest rates probably for longer. And I remember from economics in college, if you pump a bunch of money into an economy, whether it's the US economy, the Chinese economy, any economy, but you pump a bunch of money into that economy for, let's say, 2 years, as an example, like 2020 and 2021, what happens in the following years? You're going to have inflation for roughly double the amount of time that you pumped money into that economy. So we pumped a ton of money into the economy for 2 years. We're about 2 years into a cycle of high inflation. I believe we have about 2 years to go that we're going to have high inflation and high interest rates. Now,
Yeah.
you can comment. You guys can tell me all the reasons why I'm
Yeah.
wrong.
Let us know.
But
Let us know.
come back and watch this in 2 years and say, boy, that Joe guy, geez, he doesn't know anything.
That's-
Um,
You're implying, Joe, that we have high inflation right now. Do you
it's
know
higher.
we're not that far off of like a 50-year average? Now, I
That's
know
true.
the target is 2%, but I mean, does anyone even know where that target came from? Because that's not the average.
Now the average is 3. Yeah, and we're not.
3. That's right.
We're pretty close. I think we're 3.5.
Mhm.
But we haven't been at 3.5 for a long period of time. We've only been at 3.5 for a month, 2 months, 3 months.
Yeah.
So I would not be surprised if we continue to see higher than 2% inflation. So we'll call it high
Yeah.
inflation
Yeah. Fair
for
enough.
another couple of years.
All right. Anything else on the macro level? Oh, let me say one thing before we get. I want to ask Coop to chime in here, but what one caveat to this is unemployment. So if we see pain in employment, I think we could see some rate cuts.
Mhm.
So that would be the caveat. It's still under 4%. If you see it over 4, even like starting to approach 5, that's when the panic button will be pushed, and you'll see some cuts. So Coop, anything else on the macro level? Let's let Joe get into his slides here.
Yeah, well, a couple of thoughts there. Speaking of unemployment, right? And we mentioned that the government has been spending a bunch of money. Well, sometimes when the government's spending a bunch of money, that means they're hiring a bunch of people, right? And so if the government is hiring all these people, that influences the unemployment rate, right? So the high level like headline of it, right, is unemployment is going down or is holding steady, or look how many jobs we added. But you got to dig in a little bit. Are these government jobs because we're printing and spending more money, or are these actually in the private sector? So depending on how deep you want to go, or how much people want to think about that, you can dive really deep into some of these things. And it may there's there's different ways, I guess, to influence some of these things. Um, One thing I wanted to come back to, though, on the macro of the interest rates with Joe, um, you're having these very difficult conversations. You're having deals potentially fall off and die when the interest rates pop over 7%. What's it like for you as a mortgage broker to then have those conversations? Are you able to then have the conversation, and specifically the math conversation of penciling these things out and educating these buyers to try and save deals? If you're doing that, does it save deals, or is this just people see the headlines, they see the number, and they're just walking away from things?
I wouldn't say that people are just necessarily walking away, but I see that there's a lot of hand wringing. And so maybe somebody was expecting a 6.9% rate. A month later, they get on a contract and it's 7.3. So they might sit down with me. And traditionally, most people talk to 3 mortgage lenders. This is not a surprise, right? You talk to 3 people, just like when you're getting a contractor bid. You talk to 3 people. You probably don't go with the highest. You probably don't go with the lowest. You go with whoever's in the middle because they seem reputable and you're going to get the job done. What I do see is when things cross over that psychological threshold, they're not going to talk then at that point to 3 mortgage lenders. They might talk to 6 or 8. And so that's what I mean by hand wringing is there's a lot of, holy cow, I thought it was going to be 6.9. Now it's 7.3. I'm going to call 10 people. Oh, I was able to find something that got me at 7.15, right? Or 7.12. And so I think there's a lot of um, effort that goes into that to try and save just a little bit, which I understand, right? We all want to save money, but I don't necessarily see that transactions cancel. But I do then see that they will go back during the inspection and use that as a second round of negotiations. That, hey, we thought we were going to get this rate, we can't get it. Now we're going to be really nitpicky on the inspection because we want $5,000 in seller concessions to help buy that rate back down to what we were hoping we would get. So I think that's a piece of advice I would give for listing agents out there is just be really good at negotiating those inspections because some buyers are looking at that as a second round of negotiations to solve for interest rates that have gone up since they first got pre-approved.
That's really interesting, and a great tip for listing agents. conversely, for real estate investors, it's something to be aware of. To expect more negotiations, to
Mhm.
expect potentially more concessions. So if we're planning on concessions when we're underwriting the deals up front, then it shouldn't be a surprise or hurt us on the back end. If these do come up as we're listing and trying to sell our flips.
Yeah, I think you're exactly right.
All right, so I'm going to let you pull up your slides here, Joe, if you want to do a screen share there, and then we'll kind of detail it for the listener that is not watching on YouTube.
You bet.
While you're pulling this up, we hear the argument that we have record low inventory because of the lock-in effect. The lock-in effect, for those of you that have not heard this term, means sellers are not willing to list their houses for sale because they have a really low interest rate. And why would you ever pay off that really low interest rate? But I know the three of us have been saying, well, although that is true, life freaking happens. And there's
Mhm.
marriages and divorces and kids and job transfers and different things that would create, almost force people to list their houses for sale. So, with interest rates being high, with interest rates remaining high, as we just discussed, is this lock in effect real? Are we seeing any movement in inventory, Joe?
Yeah, so we've got a slide for that that we'll talk about here. In fact, let me pull that one up since that's the question here. Yes, we are seeing movement in inventory. Um, and what we're seeing is exactly what you just described, that things happen, right? Marriages, births, divorce, job transfers, deaths, having kids. And so several years ago, a lot of people said, I have a 3% interest rate. I'm never moving. Well, I appreciate the sentiment, but it's probably not real. I'm never moving for a while is probably what that real sentence is, because eventually that home doesn't serve your needs. You really like your 3% interest rate, but you need a bigger backyard. Or God forbid you get divorced. God forbid you have a death of a spouse. Something happens in life. And traditionally, that's what drives real estate, right? People buy real estate for shelter. Now, I know we talk to a lot of real estate investors, and that's our audience here, but traditionally, people buy and sell homes because of what's going on in their life, not because of what's happening in the financial markets. And I think we're getting back to more of a air quote normal market, that transactions happen because of life, not necessarily because of where interest rates are.
Okay, yeah, that's great. This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. I feel like that's accurate. Do you have like something you could show us to show us that inventory is increasing? What are we looking at here?
Yeah, so I have a very busy slide, but this is the end of month active inventory going back through 2019. So for the listeners that are
I
just
can see.
listening and can't see this, what you see is at the beginning of 2019, inventory was about 6,000 homes on the market. And this is the Denver metro area, so homes, condos, and townhomes. And so over the last 5 years, inventory peaked at about 9,500 homes for sale in June of 2019. And then what you see is inventory began to decrease very, very rapidly through the end of 2019. We all know what happened in 2020. There was virtually no inventory on the market at the beginning of 2020. And then, really, as we got into the end of 2020 and the beginning of 2021, you had 2,200 homes on the market at the beginning of 2021. Well, then what happens? We managed to survive 2021. In 2022, we had only about 1,200 homes on the market in January of 22. Well, if you're looking at the slides, you see this big spike of inventory that occurs right there, and we get up to almost 7,000 homes on the market in July of 22. Do you guys remember what happened from January of 22 to July of 22?
Yeah, that was when the rate cut started.
That's exactly right. Interest rates went from, 2 to 2.5% up to 4%. That caused a lot of buyer demand to fall off. A lot of homes continue to come on the market and we're not getting absorbed as fast. And then this green line represents inventory in 2023, which showed that we started the year with roughly 4,000 homes on the market, peaked in August with roughly 7,500 homes on the market. And now here we are, this dotted blue line over here. Again, I know the folks listening can't see this, but right now we're right around just under 6,000 homes on the market. And what do you know? That's really similar to where we were at 5 years ago in 2019. So the reason I bring this up is inventory is beginning to normalize back to what it was like pre-COVID, pre-pandemic, where we didn't have 2% interest rates driving a lot of decisions. We didn't have a lot of loose monetary policy driving a lot of economic activity. So what we're seeing is kind of a return to normalization, that people list their homes and people buy homes because of what's happening in their life, not because of what's happening in the financial market.
Yeah, so I'm trying to unpack this a little bit here, Joe. And I don't know if
It's
you
a
have
very
anything.
busy slide.
Yeah, I'm trying to extract something that can benefit us all from it. And you could definitely see the inventory going up for those of you that are not watching this. Maybe when you get home and you're not driving, go to YouTube, youtube.com/Pine Financial. This will be up there, and you could see this busy slide. But what I find interesting here, Joe, and curious what you think, Coop, if I'm trying to just guess an average by looking at this from 2019 till today, it's looking like it might be around 5,500 homes. That's a total wild guess,
Hmm.
but it's somewhere in that range. And that's, gosh, that kind of looks like we're almost at 6,000 according to this. So we're either a tad over what the average would be or right around what the average would be. So is that am I seeing this correctly, do you think?
I think you're spot on. I think we're right around just above average number of listings as we've had over the last 5 years. And looking back at the last 5 years, I think we can all agree it's been a pretty strong seller's market. And I have a slide for that as well. It's still a very strong seller's market. It's not a hyper aggressive, holy cow, I can sell my home for $100,000 more than I list it for seller's market. So it's not a crazy seller's market, but we are still in a seller's market, which continues to drive appreciation and price increases, not at the 20% a year, but at the 2, 3, 4, 5% per year, which is sustainable and average over the last 50 years.
Yeah, exactly. So we see the inventory is maybe not quite as low as we thought on a very, very local level. I know in nationally it's still at record lows.
Hmm.
But on the local level, where it sounds like we're a little bit average, but let's translate that, because what we're not seeing here, Joe, is demand. So
Hmm.
how do we look at demand?
Yeah, so I don't know if I've got a good slide for demand.
Maybe months of inventory or days on
Ah,
market
here
or
we go.
something like that?
Actually, I do have one. Here we go. So this is inventory levels going back to 2007. So again, end of month active inventory. And you can see all the way over here, we peaked at like 35, almost 36,000 homes for sale back in June of 2007. And so that was a really strong buyer's market when we had a ton of inventory. We reached a balanced market here in like 2008 to 2011. And then we've been in a seller's market really since the beginning of 2012. And we entered a dysfunctionally tight seller's market from 2020 to 22. And we're now back to a pretty efficient seller's market. So while this doesn't specifically answer the question of demand, it does show that homes are still getting scooped up by buyers relatively quickly. I believe the average days on market right now is about 35 days. And I also describe it as a little bit of a tale of two markets. If you list a property that's in a competitive area at an appropriate price and have really good marketing, we are still seeing competitive offers that you'll get 2 or 3 offers and that property will go under contract in 3 to 5 days. Now, the flip side, if you list a property too high, don't have good marketing, it's maybe a little bit of a beat up property, not in a great area, we're seeing those sit for 65, 70, sometimes even 90 days. Take the average of those two properties, you're going to be somewhere around 35 to 40 days. So it's really a tale of two markets right now, that folks that are listing their property appropriately are still getting it sold very, very rapidly because there's a lot of demand for what I would call primo properties. We're not at the point that there's demand for below average properties. So I think there's still good opportunities if you're selling a primo property, and you can get those sold pretty rapidly because there are still buyers that want to buy good properties.
So two things I'm pulling out of this slide. One, this is a much further zoomed out version of what we just looked at. So
Mhm.
this goes back all the way to 2007. The other one was 2019. So I said average of 55 to 6,000 from 2019. But looking
Mhm.
at this slide, you could clearly see that's still at historic low inventory rates.
Yeah.
And
Yep.
another thing I wanted to throw in here, and then Coop, I'd love to hear some thoughts here. You're being very quiet. Um, we know that the millennials is the largest living generation. And we know that the millennials are now entering the first time homebuyer ages. So, as far as units of demand, if you want to call it that, people that are potentially home buyers, we're much higher now than we were in 2007, 8, 9 when inventory levels were way higher. So we have a higher demand, less inventory than we did. What say you, Coop?
I think a lot of this stuff is relative. I was having a conversation with my mom the other day, and she saw a headline where I think it was either active properties or days on market, skyrocketed. I think just before we started recording, we looked at something that showed I think it was active properties jumped what 46% or something like that.
Yeah,
Maybe
very
we'll
good.
show
That is
that in a second.
46%. Yeah.
And my mom was like, "Oh my gosh, like there's so many properties on the market. Like, are we going to crash? Are our values going to go down?" I was like, "Whoa, whoa, whoa, mom! Like, let's unpack this a little bit more here, right?" So, and I kind of went through this slide. I was like, "Okay, so we're about maybe 5,500, 6,000 houses on the market, right?" But to put it in perspective, go back to '07, right? When everybody remembers the huge crash, how terrible the world was. We had 37,000 properties on the market, right? So relatively speaking, we're nowhere near what that was. And so yes, there was a huge spike, but what did that actually equal in number of I think it was what the days on market or the months of inventory, I think. It went from like 1.2 to 2.4 or something like that. So I
Mhm.
mean it's still a very strong seller's market. But most folks are just looking at the headlines, right? And of course, who's making the headlines? The people who want to sell newspapers and ads and stuff. And so they gotta come up with these catchy headlines. So I think for all of us as real estate investors, we really got to dig in and understand what's going on behind the headlines so that we can be better prepared with what to do in our personal investing. Should we be buying? What neighborhoods? Should we be just turning and relisting and wholetailing properties that we're buying, or should we put some money into it and spruce them up a little bit and price them fairly? Right, just like Joe has said, those are the properties that are going to go in 3 to 5 days, especially for listing agents. That's something that they should be talking about and working on with their potential sellers. I've looking at a deal that we may fund where an investor came in and basically partnered with the seller. They were facing foreclosure. The property was distressed, and the investor, instead of just straight up buying the property and trying to compete with all the other investors trying to just pay cash for the property, they're coming in and partnering with the seller, fixing up the property, and then they're going to sell it and they're going to share in the upside of the property. That's another way that investors could be approaching this type of market so that they can have a very nice property on for sale. And obviously, you got to do the other things, which is pricing it accordingly. But by doing that, there's other ways, other options when it comes to trying to do fix and flips, get good deals, and of course, make money in these markets.
Mhm.
Cool. This is all great stuff, Joe. What else you got for us?
All right, let me share. Justin touched on a few moments ago. What about, is it still a good time to buy? So let me pull up a slide I've got for that.
Yeah. And while you're doing that,
Yeah.
fact check me maybe, but I saw somewhere there was a Fannie Mae or a Freddie Mac survey that just recently was released about confidence in home buying right now. And that according to that survey, 76% of Americans say it's a poor time to buy.
Oh, I have that
Isn't that
slide.
crazy?
It's insane. Yeah, it's absolutely insane. Oh, I don't have it on this one, but you're exactly right. 76% of people think that it is not a good time to buy. And I wish that the survey dug in further, but a lot of surveys just have one or two questions on them. But my experience, here's why people think that. Prices are high, interest rates are high, and then what does everybody forget to talk about? HOAs are high, taxes are high, insurance is high. The cost of owning a home has increased in all 5 areas that impact that. Therefore, people say, hey, it's too expensive to buy. I'm going to wait for some of those things to come down. And so the slide I have up here is from the last time that there were articles saying it may be a good idea to wait was right around 2010. And we looked at the slide of how much inventory was out there. Well, if you would have been a renter in 2010, your average net worth of the average renter was $5,400. Over the next 12 years, over here to 2022, that renter, their average net worth increased to $10,400. Now, the average net worth of somebody that owned a home or bought a home in 2010 was $187,000. So that same person that bought a home now has an average net worth of $396,000. So the net worth of somebody that bought a home in 2010 versus somebody that did not buy a home in 2010, that average net worth increased by more than $200,000. So let me ask you guys this. 76% of people think it's a bad time to buy a home. What do we think this chart is going to look like if we extend it out another 12 years to 2034? Do you guys think that this $396,000 of net worth is going to go down over the next 12 years? Or is it likely to increase? And unfortunately, the renters are going to remain relatively flat. What do you guys think?
Joe, you're leading the witness here.
You're welcome.
I'm trying to find like the polite way of saying this, because I mean the thing I'm hearing in my head is that the rich get richer, but I mean this we're not necessarily rich, right? We've just bought a home, you
Mhm.
know, but because we bought a home, our net worth is skyrocketing. If we buy our own home and maybe one additional rental property, right? I mean, these numbers would double if we had two properties
That's
potentially.
right.
So it's not necessarily that the rich get richer; it's just those who are willing to, I don't know, get off the sidelines, take a little
Mhm.
risk and buy a property or two. The impact for their family, for their kids, is going to be tremendous.
Mhm.
And why are people on the sideline? They feel that it's unaffordable, which in some ways it's expensive,
Mhm.
relatively speaking, but it's not unattainable.
Yeah, and I
Yeah.
think
So
it
my
really.
thought,
Oh, Kevin,
oh,
you go.
yeah, real quick thought. If the 76% of Americans think it's bad to buy right now, and it's because of home prices, it's partly interest rates. I agree with that, but interest rates can be refinanced, right? So you're not married to that. We all hear that. But if you're waiting for a value decline, a softening to make it more affordable for you, I think it's a mistake. And here's the main reason. There's lots of reasons why. And Joe, I know you do a lot of great webinars and seminars and talk about this. There's lots of
Mhm.
different reasons that support this concept. But one that we don't talk about very much is the Federal Reserve, you guys, now has a legitimate tool to keep the economy stable. Now we're at over a 5% federal funds rate. That's a lot of room for them to bring rates down to stabilize the market. If you were at a 0 or a quarter point like it was for so long, there's no room to lower it any further, right?
Yep.
So if you go into a tailspin, you're going to kind of have to live through the tailspin. I just
Mhm.
don't think that's gonna happen now.
I don't think so either. And if you'd like, I do have a couple of things to talk about on is there going to be a foreclosure and is there going to be, is there going to be a foreclosure boom and is there going to be a softening of prices? All right. So will the number of foreclosures go up? Well, the leading indicator for foreclosures is delinquencies. All right. And consumers have to fall behind on their mortgage. They have to be behind for 90, 120 days. And then that foreclosure begins. Well, check this out, guys. We are near record low levels for the last 45 years. All right. Foreclosures peaked, pardon me. Foreclosures peaked at above 4.5 to almost 5% in 2008 to 2011. We are currently less than 0.5%, which is the lowest that we've been at since 1983. All right. So people have to fall behind on their mortgage, and to go to foreclosure, you generally don't have a lot of equity, because if you have equity, are you going to let the bank take all of that when they take the home back? No. What are you going to do? You're going to call your real estate agent and say, hey, I fell behind on my home. Can you help me sell it so I can get this $100,000, $200,000, $300,000 of equity? All right. So what we see is homeowners are sitting on a record amount of equity. There's more equity in US homes than there has ever been in history. All right. So if somebody has a ton of equity and they fall behind, they lose a job, they experience an illness, the death of a spouse, and they can't make the payments, very low odds that they're going to just let that home go to foreclosure. They are going to call their real estate agent and find a solution to sell that home. So folks that are waiting for a crash in prices or waiting for a foreclosure boom, I hate to be the person delivering the bad news. Very unlikely to happen.
Yep. And there's a lot more statistics that support this claim as well. Equity is a great one. You went to the foreclosure rates. That's a great one. You want to look even further forward, you'd be looking at 30, 60, 90-day delinquencies. Those are at record lows. Like, we've looked at this any way possible. The one argument that I think may have some legitimacy to it is consumer debt. I don't want to have a big, huge conversation here because we actually have to get wrapped up, but consumer debt is at record high, and you are starting to see credit card delinquencies. All of this is true, but what it's not is adjusted for inflation and wage growth. So
right.
Even though it's at record high, it's not at a record high percentage to income. So it's still very much affordable if you look at it through that lens. Let's talk about days on market or months of inventory quickly, because Coop brought it up. So I'm looking right at it now. I don't need to share a screen, but it went from 1.5 in April of 2023 to 2.2 in April of 2024. So this is the most recent statistic. That's a 46.7% increase on months of supply. So that's the headlines that Coop was talking about. New listings have also gone up over 40%. But those are kind of tied together, right? Because months of supply does account for inventory. So it would make sense to see both of those increase at the same time. So 46 sounds scary, but it's still 2.2, which is less than half of a normal neutral market. So to Joe's point, it's still very much a seller's market, which is why we're seeing values increase still.
Yeah. So an analogy that I like to use when we're talking about inventory, and when you see those headlines that, inventory has increased 46%, holy cow, this is probably an emergency. Well, I think about it like this. Let's say I drank 2 beers yesterday. All right. And today I drank 3 beers. Well, my alcohol consumption went up by 50%, but that doesn't mean that I'm out just being a complete menace to society, right? So that 50% increase is not the same as if you drank I wouldn't do this, but if Justin drank 12 beers yesterday and then today he drank 18, all right, that's a meaningful 50% increase. But when the starting number is so low and you go up just by 1, and yes, it's a 50% increase, but it's not the same as going from 12 to 18 or, any other analogy that maybe is more appropriate for your listeners. But these are real.
I've seen you on 3 beers, man. It's scary.
That's true. That's not my best look.
Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.